Many new investors are experiencing anguish and sorrow from the current stock market meltdown. But when will it end? When will the stock market bottom? And when is the best time for you to buy into your next investment? Fears of increasing lasting inflation, the rising of interest rates, and an economical contraction have hit the stock markets throughout the globe very hard in 2020. The Nasdaq Composite Index, which is heavily weighted in tech stocks, has dropped more than 30% since November last year, with much more room to fall to the downside, and investors are panicking. But just wait, do not start filling out that McDonald's job application just yet, because it's not as bad as you think. In this video, we're going to look at what it means when the stock market crashes and also the phases and cycles markets typically go through. We're also going to examine the history of the bull and bear markets to determine exactly when stocks could finally stop dropping. And more importantly, when you can start buying up equities and stocks at a much discounted value, meaning much more tendies. Now, in order to get a clear idea of when the stock market will stop crashing, we first need to understand how and why the stock market crashes in the first place. A bear market occurs when the main market index, often the S&P 500, drops by more than 20% from its most recent high point. This is a bear market definition for the market generically as a whole. However, a bear market can also be said to exist in a certain number of stocks or groupings or a sector which have also dropped by 20% from their respective highs. Whenever the stock market currently drops in value, we call it a crash, because it's like coming down from a big high after a heavy night on the town drinking a 40-year-old scotch, which of course is something on this channel I know nothing about. Investors and traders rise a high on euphoria at record high after record high until at some point you look around and realize everybody's left the party and the girl you've been talking to has currently stolen your wallet, and that 40-year-old bottle of scotch is actually nothing but a crappy bottle of Jack Daniels. It's like being in a head-on vehicle collision at a staggering speed where no investor has time to jump out and escape before the time of collision. To illustrate this point, if you examine the past stock market crashes, you'll find on average the whole stock market slump lasts around 9 months and causes roughly a 28% decline from its high. Now, losing roughly a third of your wealth in less than a year, of course, is a big kick in the Sandra Bullocks. But it could be worse. Imagine you were Cathie Wood, and not only have you lost more than that, but now everybody's realizing you actually had no clue what you're talking about. If you've ever listened to legendary investor Ray Dalio, you will know that he loves cycles. And of course, no, not that thing with wheels and a cute little bell, but the repetition of particular patterns over a short or long period of time. And when we're trying to forecast when this merry-go-round of pain will eventually stop, we can arrive at a good guess by looking at previous bull and bear cycles. However, the specific magnitude of a stock market collapse is less important than the emotions and experiences it evokes on investors. And I'll clarify what I mean by that very important point in this video. There is a constant pattern of each investor's attitude during each boom and bear cycle. The ability to recognize herd mentality for what it actually is and maintain a level head is absolutely crucial to be successful in any form of long-term success from investing. As a stock price rises, investors become more certain that the market has turned. The fear of missing out, or FOMO as it's known as, drives investors back into the market. Their confidence becomes so unbearable that they just continue piling more and more cash. Those investors who sold stocks at the bottom genuinely re-enter at this time, losing out on much of the already made gains. The economy begins to overheat, inflation runs higher and higher, policy authorities start cutting back on economical stimulus and eventually raise interest rates. This causes a sell-off as spending slows down, and logical investors with experience start cutting back on their positions as earnings are set to go down. That's where we currently are right now. This sell-off frightens novice investors, but they're so accustomed to stock market gains, they hardly notice until it's too late. And if you're watching this, be honest, how many stocks are you currently back holding? Although the market is falling, investors still believe that equities will eventually recover because they always have in similar situations in the past. Investors now enter the worst part of this cycle of mentality, and that is the denial phase. As their profits evaporate and turn into massive losses, they live in hopes, actually no, they live in prayers that their stock prices will recover, and if they recover just enough to a break-even point, they will sell everything. So to bring their average lower, they start investing more and more into losing plays, sometimes even using leverage. But when these losses become too great, a mass exit event occurs. A sudden large day loss could just scare every investor, and those who took leverage could actually be forced to sell at a massive loss, adding even more selling pressure to the market. It's at this point majority of investors bail out, and that's really the bottom. Although at this point, the market might stay low and stay stagnant for a pretty long time, maybe even years from what we can see from the past. But this is actually sort of the first indication we have actually indeed reached some form of bottom in the market, and it could represent the opportunity to start buying up some very discounted equities. It's when the stock market starts to feel like a ghost town, when most investors have fled out from fear and despair, leaving behind only the most committed bag holders, kinda like those apes who are still bag holding that AMC train, only though with a normal company like Apple, there's light at the end of the tunnel, not a track that is missing and you're willing to fall off a bridge. It's at this point logical investors should be very excited. If you're a member of our WhatsApp group, you will know at this point I'm starting to get very excited and I'm really looking to buy some equities I wanted for years on a massive discount. It's at this point when investors have lost all hope. This is the beginning of the new bull cycle. Not when equities reach new highs. The bull cycle actually starts at the bottom. So what patterns can we take from previous bear cycles to tell us when the market might actually start turning into a bull cycle again? Well, you've already seen this. You've seen the constant bombardment about the alleged collapse of the economy. Everyday finance YouTubers, including myself, will tell you the world's coming to an end. This time, guys, seriously, this is really bad. But rather than get caught up in this negative news cycle, if you're in need of some fresh perspective and serenity, think about the average stock return over your lifetime. They always say it's much darker before the dawn, and what you want to see is the darkest time in the stock market to start snapping up your equities. If we look at the last 12 cycles dating back to 1956, the average bear market lasted just 9 months. From their high point, prices generally dropped around 28%. Some bear markets did though not lead to all-out recessions, while others did see a decline in economical activity. While recessions typically follow a bear market, the market dropped on average 35% from its high point. If we glance over historical charts, however, like the S&P 500 over its lifetime, it shows that stock market collapses are actually very rare. The market actually spends much more time running upwards in a bull market than it does actually declining in value. In essence, meaning the market goes up much more than it goes down. So you can expect if markets continuously go upwards, you should expect a correction or a bear market at some point. The typical bull market actually lasts 6 times as long as the average bear market, and it sees an average price increase of about 130% of the lows from the previous bear market. Looking back at 2020, it was clear that we were approaching the crest of a bull market wave. As much as 15 trillion US dollars was injected into the economies throughout the world, with 8 trillion alone going into the United States. Since consumer spending dried up during the lockdowns, the only place available for cash to go was in turn the stock market. And that's one of the reasons why we basically escaped a big bear market in terms of equities. Stocks and other assets like NFTs rose as investors put their stimmy checks into anything: Tesla, Apple, cryptocurrencies named after Elon Musk's dogs, and of course, the big one, Pokemon cards. Literally. And thinking about it, how can you not deny that we were in a bubble back then? Average people who had never invested in their lives were suddenly afraid of missing out on stock market rewards and had to be involved in this feeding frenzy on stock market gains. Retail investors even borrowed money heavily in order to increase their gains out of sheer greed. But this in turn actually will only magnify their losses when things go south. The Federal Reserve has since sharply reversed its course from near zero interest rates, and instead of purchasing government mortgage bonds, they're actually making loans more and more expensive, meaning it's harder and harder for people to have surplus income to invest in stocks. The federal government is also contributing to the economical slowdown by cutting spending to pre-pandemic levels. The Fed is anticipated to continue hike rate increases and decreasing its bond holdings far into next year, which suggests that the stock market will go from bad to worse. So if the market is going to continue falling downwards in the next year, where should you actually invest your money? Believe it or not, there is actually a set criteria for investing into a downturning market. There's a system that you can not only survive, but indeed thrive throughout the long term of economical downturn. As a long-term investor, you just basically need to have a plan, and this plan will guarantee that you get a very good deal getting stocks way below their peak. Everyday investors should not worry if this is the bottom of the market, or indeed if this is the right time to invest in case markets continue falling. Investors who want to try and time the market will see market downturns, panic out into a fake bottom, and miss upside potential. They'll overreact by selling too soon and watch the market decline further, only to rally the next day. They'll then buy the top of that green candle and the market will sell off. No investor can time the market. It's at this point good logical investors will be made, because if you have a simple plan of just building a time frame, a period, and a set amount of money to invest regularly into a global ETF or the US, the S&P 500, and just invest this amount every single month, quarter, whatever you determine, it just takes the emotion out of it. For example, let's say you just pick a fixed amount. I'm going to invest $200 every single month for the rest of my life until I retire into the S&P 500. Does it really matter what happens tomorrow to the stock market? In fact, if you make that decision, you want the market to fall as much as possible so you can actually get as much value as possible. This will lower your average into the market as it falls lower, meaning when it recovers, your gains should be much, much better than they actually would be if the market rallied tomorrow. But more crucially, you have a clear strategy to adhere to, meaning you won't panic out of the market if it continues falling. In essence, who actually cares? Just continue investing each month. But one last big tip I would say to investors and people who want to take their financial responsibility very seriously. Right now is a time for you to go out and get a side hustle. Go and earn as much cash as you possibly can. Take an extra shift at work if you need to. Go and get them extra revenues to make sure you can take advantage during the next couple of years during the market downturn, and invest it. Bear markets do not continue forever, and now with prices low is the perfect moment to start buying and eating as markets fall. If you haven't got money set aside to take advantage of this, then the next best thing is to go and generate money so that you can invest into this falling market. This doesn't mean go and get a full-time second job and have no time to go at the cinema with your boyfriend or girlfriend. It just means go and do a little side hustle, drive an Uber, deliver Domino's pizza. There's no shame in it if it amounts to you stepping up and having an extra 100K at the end of your life at retirement. If this current fall in stocks and assets does end up becoming the mother of all crashes, as legendary short seller Michael Burry predicts, then you will definitely want to have enough cash set aside to scoop up some of these solid businesses. By looking at history from the viewpoint that the stock market collapses and then eventually transforms into a massive bull run, it will serve as one of the greatest possibilities and eventually long-term profitabilities that you might ever have a chance to take advantage of. Take advantage of this whole the world is ending doom and gloom mindset. Honestly, it could never happen again in your lifetime. This could be the very last chance you buy the market at its current lows. So if you're still at the end of this video asking, when will the stock market bottom? When will be the perfect time to buy equities? You're asking the wrong question. What actually matters is that you start taking advantage today and making sure you're ready to take advantage when the market will indeed bottom. And in fact, before and after this occurrence. But it is essential you pick the right stocks, the right businesses with the right fundamentals so that they do not go bust during this bear market, because many companies will go bust in the coming months. And if you want to learn how to pick the best stocks, this is how Warren Buffett does it right here. If you could drop the code word in the comments, which is market bottom, it would greatly help me out with the YouTube gods. Thanks for watching and good luck out there, and I'll see you in the next one.